If you were watching the market after the bell today, that's Tuesday, February 3rd, 2026, you might have seen something, well, a little unusual.
You mean in an age of AI and biotech stocks going wild?
Exactly. One of the biggest after-hours movers wasn't some flashy tech company. It was a company that works with, steel pipes and heavy hydrocarbons.
Marathon Petroleum, MPC.
That's the one. The earnings report came out, and boom, the stock shot up over 5% in extended trading. And looking at the volume, it seems like a lot of people were caught by surprise.
Which is funny because the signs were there if you were watching the refining sector. The setup was good, but the
Mhm.
way Marathon actually executed in Q4, that was something else entirely.
And that's exactly what we're going to unpack. We've got the full set of documents here, the Q4 2025 earnings call transcript, the slide deck, the press release.
And our mission for this deep dive
Mm-hmm.
is to really understand how a legacy refiner, I mean, let's be honest, that's what it is.
It is.
How it's not just surviving, but really thriving in the 2026 energy market. We're talking extreme efficiency, we're talking geopolitics, and, the surprise connection to the AI boom.
Oh, I definitely want to get to the AI part because that sounds completely backwards for an oil company. But first, we have to talk about the numbers, the money. I'm calling this segment the financial fortress.
A good name for it because the results were, frankly, staggering. Let's just start with the headline beat.
Okay.
Wall Street's consensus for earnings per share, EPS, was about $3.73.
And Marathon came in at.
$4.07.
So that's, what, a 9% beat? In a mature industry, that's huge.
It's a very wide margin. And then you zoom out. For the full year 2025, they generated something like $12 billion in adjusted EBITDA.
Right.
But the number I always look for, the real operational number, is cash flow.
Right.
$8.3 billion in operating cash flow for the year.
Let's just sit with that for a second. $8.3 billion in cash. I mean, there are high-flying tech stocks in the S&P 500 that don't generate anything close to that in actual cash.
And the big question is always, what are they doing with it? Because we all remember the old days, right? Energy companies would take that cash and just plow it back into the ground.
The drill, baby, drill playbook.
That playbook is dead. At least here, Marathon's entire strategy is about returning that cash to shareholders. In 2025 alone, they sent back $4.5 billion.
Was that mostly dividends or?
It was a mix, but the buyback is the really aggressive part. They cut their total share count by 6.5% in 1 year.
6.5%. So as an owner, your slice of the pie just got bigger without you doing a thing. That's powerful.
It is. And it's coming from the CEO, Marianne Mannon. She kept repeating this phrase on the call. Industry-leading cash generation. That's it. That's the goal.
And they just brought in a new CFO, right? Maria Corey.
Yep. And her background is all about operational excellence, a lean mindset. It signals that this isn't just a one-time thing. They're building this discipline into the company's DNA.
Okay, so that's the what. They're making a ton of money, but I want to understand the how. How are they so profitable when oil prices are all over the place? This gets us to the secret sauce.
Ah, yes, the capture rate.
Right. They put this in the slide deck. A capture rate of 114%. Now, my math isn't great, but how do you capture more than 100% of something?
It sounds like magic, doesn't it? But it's actually pretty straightforward conceptually. There's a market benchmark, like a formula, that says for a generic refinery, if crude costs X and gasoline sells for Y, you should make Z profit. That Z is 100%.
Okay, so that's the baseline.
Right. But Marathon is not running a generic refinery.
Mm-hmm.
They beat that baseline by 14% because of the type of crude they buy. Almost half their diet is sour crude.
Which sounds bad, but it just means it has high sulfur content. It's messy.
It's messy, it's heavy, it's hard to refine. And because of that, it's cheap. It's the discounted stuff. Marathon's super complex refineries are built specifically to take that cheap sludge and turn it into the same high-quality gasoline and jet fuel as everyone else.
So that price difference, the spread between the cheap sour crude and the expensive sweet crude, that's almost pure profit for them.
It is massive. They actually put a number on it in the call. For every $1 change in that sour-sweet spread, it impacts their annual bottom line by $500 million.
$500 million for a $1 price change. Okay, now I get why they're obsessed with commercial execution.
Exactly. And this is where things get really interesting in 2026 because of the geopolitical shifts. You saw the part about Venezuela.
I did. I had to do a double take. They bought 2 cargoes of Venezuelan crude.
They did. That oil has been off the market for years. Now it's coming back.
Yeah.
But the CEO was very clear about this. She called it optionality.
Meaning they don't need it.
They don't need it. They're not dependent on it. They put it on the screen next to Canadian heavy, Mexican Maya, Alaskan crude, and they just click buy on whatever is cheapest that day.
But there was this other angle I thought was brilliant. Even if they don't buy a single drop of Venezuelan oil, they still win. Explain that.
It's just basic supply and demand. More Venezuelan heavy sour crude on the market creates more competition for, say, Canadian heavy sour crude.
So it pushes the price of Canadian crude down.
Exactly. And since Marathon is one of the biggest buyers of Canadian crude in the world, their main ingredient just got cheaper, even if they never touch the Venezuelan stuff.
Right.
It widens that profitable spread for them.
That's playing chess while everyone else is playing checkers. Okay, let's shift from the raw materials to the finished product, to the where. Refining is all about location, location, location. And it sounds like the West Coast is getting very interesting.
It's getting very tight. It's a classic supply story. California and the Pacific Northwest are sort of an energy island. It's tough to get fuel there from the Gulf Coast.
And now someone's leaving the island.
That's right. A big competitor, Phillips 66, is shutting down their facility in California this spring. And for Marathon, who has major assets in Los Angeles and the Pacific Northwest, that's a tailwind.
Fewer suppliers, same number of customers.
Or even more customers. Jet fuel demand out there is up almost 4%, and Marathon is the single largest producer of jet fuel in the U.S. So you have a competitor disappearing just as demand is rising. That's a formula for very, very strong margins.
Which, again, feeds into this optimization theme. They're not building new capacity, they're just making their existing capacity more valuable.
Which brings us to their spending, their CapEx. This also caught my eye. They're actually cutting refining CapEx by 20%.
In a year when they're making billions.
Exactly. This is that capital discipline we talked about. They're just not spending money unless a project can generate a 25% return. That's the hurdle.
So what kind of projects even clear a bar that high?
Small, high-impact stuff. Like at their Galveston Bay refinery, they're building a new DHT, a distillate hydrotreater.
Okay, in English, what does a hydrotreater do?
Think of it as an upgrade machine. You feed it high-sulfur diesel, which is worth less, and it strips the sulfur out, turning it into ultra-low sulfur diesel.
Which sells for a premium.
A big premium. So they're not processing more barrels of oil, they're just increasing the value of every single barrel that goes through the plant. That's pure margin enhancement.
Efficiency, efficiency, efficiency. Okay, now let's make the connection I promised. This old world industrial giant and the AI boom, how does that possibly connect?
So the connection is buried in their other business, the midstream segment. It's a company called MPLX.
That's their pipeline and logistics arm, right?
Right. Marathon controls it. And MPLX is enormous. It handles something like 10% of all the natural gas produced in the entire United States.
7%, okay.
Now think about where the new demand for natural gas is coming from. It's not people's home furnaces.
It's power generation.
It's power generation for data centers. The earnings call explicitly said that the projected 15% growth in gas demand by 2030 is linked to power needs from data centers.
AI chips. They're incredibly thirsty for electricity.
Exactly. You need massive 247 reliable baseload power to run these AI models. You can't have your cloud service go down because the sun isn't shining. And right now, the fuel that provides that reliability is natural gas.
So the chain is AI boom leads to more data centers, which need more power, which means utilities burn more natural gas.
Which MPLX transports through its pipelines. And since Marathon owns most of MPLX, they get the cash.
And it's a lot of cash.
A huge amount.
Yeah.
MPLX is growing its distribution by 12.5%. For Marathon, that means $3.5 billion in cash comes back to the parent company this year.
$3.5 billion. I was looking at their financials, and one cash stream basically covers their entire dividend payment to shareholders and their capital spending.
And that is the whole model. The stable, boring pipeline business pays all the bills. It sets the floor.
Which means all the profit from the more volatile refining business is just excess.
It's pure gravy.
Yeah.
It can all go straight to those share buybacks we talked about.
Yeah.
It's a beautiful de-risked model.
It is, but nothing is completely risk-free. We have to touch on the couple of warning flags in the report. First, the labor situation.
This is the big immediate risk. Their contract with the United Steelworkers, the USW, it actually expired on January 31st.
So just days ago?
Right. As of the call, they're working on rolling 24-hour extensions.
That sounds incredibly tense. for everyone involved.
It's got to be a nightmare for the plant managers. You have no idea if your workforce will show up tomorrow. A strike or a lockout could shut down these cash machines instantly. It's a major overhang.
Okay, so that's the people risk. What about the green business? The renewable diesel segment looked pretty weak.
It was worse than weak. It basically collapsed. EBITDA there dropped from 28 million a year ago to just 7 million.
Wow. And this was supposed to be the growth engine for the future? What happened?
It's a tough market. A lot of new supply came online, and the cost of the feedstocks, the used cooking oil and soybean oil, that went up. It's just very hard to make money in that business right now.
So the irony is the dirty, sour crude business is printing money, and the clean, renewable business is barely breaking even.
It's the paradox of 2026. The old, optimized, essential infrastructure is incredibly profitable. The new stuff is still trying to find its footing.
So let's bring it all together. The so what? For everyone listening, we've got a stock moving up, huge buybacks, but also some real risks. What's the main lesson here?
I think for anyone trying to learn about business strategy, this is a case study in capital discipline. Look at what they're doing. They're not chasing growth. They're actively shrinking their share count to make each remaining share more valuable.
It's a shrink to grow strategy.
It is. It's like a private equity approach in a public company. Maximize cash, return it to the owners, and don't spend a dollar unless you absolutely have to.
Okay, so here's the final thought I want to leave everyone with. We are all so focused, and rightly so, on the energy transition, on EVs, on solar. But what Marathon's results suggest is that for the rest of this decade, the most valuable assets in energy might not be the new ones.
They might be the old, complex, hard-to-replicate ones that are essential to the economy right now.
And if they're right that demand for gasoline and jet fuel is going to outpace supply for years to come, then this boring old refiner could end up being one of the best performing stocks out there.
It's a very real possibility.
Something to think about. That's all for this deep dive. Thanks for joining us.
Thanks, everyone.